Well, good afternoon once again, everyone. This is Cynthia Tomaine with Interactive Brokers. But for today's presentation, I did want you to know that we're very pleased to have Nancy Nelson, who not only a CPA, is the tax director at Interactive Brokers. So Nancy's got some information for you today on trader or investor. So Nancy, I've passed you the ball. Let's go ahead and get started. Thanks for joining us.
Terrific. Welcome, everyone. So I'm going to talk about being a trader or investment for tax position today, and it's a very important decision, but not an easy one to make. It's an area of interest to the IRS. It's one that takes careful consideration with your tax advisor, and one where you have to really pay attention to what you're doing and keep good records. I have one point in this coming up in one of the slides, I believe, that I said that the whole slide just says document, document, document. And although that's always critical for taxes, I can't stress that enough as a tax preparer. It's particularly important in this area because if you elect to be treat yourself as a trader or be a trader, it is very likely that the IRS will audit you. And if you keep good records, it should be no problem. But if you don't, you've sunk your ship before you've even started, so to speak. So let's get to the next slide, which is the traditional IRS Circular 230 notice, which for those of you who aren't accountants, this is all accountants who do tax presentations are required to put this notice there and to say that this is not to be considered tax advice and cannot be relied on. You certainly should talk to your own personal advisor. So enough for the IRS. We've done their little disclaimer. So let's talk about what we're going to focus on here today. We're focusing on U.S. individual taxpayers, Form 1040 filers, and that, as I started out with, determination that you are a trader takes careful consideration, good documentation, and you really, really need to focus on, do I meet the rules? Because the downside of if you decide you're a trader and you don't meet the rules and the IRS challenges you is they could force you for increased taxes, penalties, and interest, and potentially false filing penalties also. So let's talk about the difference. What's the difference between a trader and investor? Most of us are investors, and basically that means that we hoard our little pennies, we invest them in the market, and we hold our securities mostly for the long term. We don't watch the market every day, we don't necessarily trade every day, or even several times a day. Even if we trade once a day, we're still an investor in the IRS's eyes. This is the default position for all tax returns. Traders are those who trade very frequently throughout every day. And that's a very important. Frequently and every day are two very important words in that sentence because that's some of the things that the IRS looks for. They don't consider someone who trades one trade a day a trader. If you trade consistently every day, 10, 12, 15, 20 trades a day, then maybe you are a trader. But those two words are key in that sentence, and I can't stress that enough. So, moving on. What's the advantage, or let's talk about the advantages of being an investor or a trader on your tax return. Most investors can't utilize investment expenses as deductions. So what do I mean by that? First of all, investment interest. You have to be an itemized filer, meaning that you have to itemize your deduction, and you have to have investment income to offset your investment interest expense. Likewise, if you pay advisory fees, those are miscellaneous itemized deductions. Again, you have to be itemizing, and those must, before you can deduct the first dollar, you have to go over 2% of your adjusted gross income. And for those of you who are familiar with your tax returns, you know what your adjusted gross income is. It's the very bottom line of the front page of your tax return is your adjusted gross income. Traders can deduct these investment expenses. They file as if they're running a business on a Schedule C of a 1040, which is the form for an individual proprietor's business or single member LLC's business, and they can deduct this investment expenses against their income and other ordinary income. But Notice these big, bold words here. It's a very stringent standard to qualify as and there's a mistake in as a trader, it should say. There's a mistake in the slides that I've just found. Of course, you always find these in the middle of the presentation, not when you're reviewing it. So the standard is very stringent to qualify as a trader. So we're just going to, if I could X this out, I know there's an eraser here. I think I can do it. Yeah, it doesn't work. All right, we won't. Just cross that word out in your slides and make a trader. All right. So what's the definition? A trader, according to the IRS, or according to the tax code actually, is a person engaging in the business of trading securities for their own and perhaps others' accounts. So note this is an important definition for this cause. It's a person engaging in the business. All right? So the IRS wants this to be your business. That's what they want you to say. They want to say your sole, not maybe your sole revenue source for your living expenses, but your primary revenue source, or one of your primary revenue sources, is trading in the marketplace. It's a business to you. Obviously, profit motive is a necessary element, but it's not alone sufficient to be seen as a business. So you've got to be careful here. Obviously, everybody wants to make money in the marketplace. We wouldn't be in it if we didn't. But it's only a secondary factor. It means that you've got to engage in this as a regular trade. So that's what they're looking for. They're looking for this to be something you do every day on a regular basis and look to benefit from short-term swings in the market. So I'm going to go through some of the logistics here. We talked a little bit about the expense side, that traders can deduct them, but how do they treat gains and losses? They're exactly the same as investors, and because of time, I have to presume you have some base knowledge about this. You have tax lots. Sales occur either first in, first out, or in the inventory method, or via specific identifications, which means you match your sale to a certain long lot every time you do through Tax Optimizer. Holding periods, short-term and long-term, apply for assessing tax. So that's the same exact treatment. And I've just run by this again, just for those of you who are not familiar with the current short-term versus long-term capital gains rates. I've stuck this in there just to remind us. The short-term capital gains are ordinary income. They're taxed the same as your wages that you get on your paycheck. And there's currently for 2013 or 2014, 3 long-term capital gains tax rates, and this is the current law in effect. It's 0% for those in the 10 to 15% tax bracket. It's 15% in all the other brackets except for those in the 39.6% bracket where it's 20%. And just to give you a frame of reference, that means those with AGI, if you're filing single, for $406,750 for 2014. I'm sorry, that's the 2014 amount, and $457,600 if you're married filing jointly. Okay. Being a trader doesn't change. I'm going to go back to this slide. The reporting of this, you still use our Form 8949 to report gains and losses that flows up to your Schedule D and then up to your 1040 in your tax return. You are still limited to losses being taken against other ordinary income of $3,000. As we start to talk about this a little bit more, we'll see that traders have almost entirely short-term capital gains. And that impacts several different things. One is that all your gains or losses are going to be taxed as ordinary income. You might run up against this $3,000 a year limit if you have losses. And it can affect your qualified dividend treatment because remember, in order to qualify as a qualified dividend, you not only have to meet the U.S. source or ADR traded in on the major exchange in the U.S. requirement, you have to hold the security around the payment date or the date of record for 61 days. So most traders have few, if any, qualified dividends that qualify for the rate. And I'm sure that's confusing because most people think that if it's on your 1099 as a qualified dividend, it meets that requirement, but it doesn't. It has to not only be eligible to be treated that way, it has to meet the holding period on qualified dividends. Okay? So what about mark-to-market? A lot of traders talk about, I mark-to-market. And you can if you elect to be a trader. But it's an election, and it's for traders only. Investors can't do this. It's an annual election that you have to file with the IRS by April 15th of the year it is to apply to. So in other words, if you decide that you are going to be a trader for 2014 and you want to mark to market, which means every day you mark your securities to market and recognize the gain or loss for that day, you have to tell the IRS this by April 15th of 2014. And if you want to look at the reference, and I've put the actual code section of the Internal Revenue Code here, it's section 475 of the Internal Revenue Code. Okay? Now I want to stop here for a minute because I'm worried that we're going to get ahead of ourselves on questions, and I want to make sure that if you have any questions, you know to drop them in the chat box. I will look at them. I may answer them directly. I may not answer them directly, or it may be that you're a little ahead of my presentation with your question. One of the questions that's come up, does a trader with a regular job need to start a second business to qualify as a trader? And I'm assuming you're asking, can you be treated as a trader if you also have a regular job? I'm interpreting that question to mean that. And the answer is yes, you can, but you have to be a little bit more careful. If you have a full-time position, you need to be able to show that you are still in the marketplace short-term on a regular basis daily, which means that you've set up your trades, you're looking to benefit from short-term swings in the market. Let's talk about that, and we're going to talk a little bit more about what that means and how many trades that the IRS looks at as we go along in this presentation. So I'm going to kind of set that to the side, but yes, the kind of thing is that you really do start a second business to do this. But you still can qualify if you have another job. So let's talk about these investment expenses. For investors, itemized deductions, they're subject to the 2% AGI floor as we discussed. I mentioned earlier, you have to be itemized. And this year, what they call the P's limitation, it's named after a former congressman. Somebody said, did you really mean P's? And I do, it's his name. That itemized deductions are start to phase out at adjusted gross income, and these are the 2014 amounts, not the 2013 filing amounts, of $254,200 single and $305,050 married filing joint. And for those of you who were on my year-end tax presentation, I talked a little bit about the marriage penalty, and here you can see it in action where itemized deductions phase out much faster for married filing jointly filers. Okay, for traders, these investment expenses are fully deductible on your Schedule C for your business. Account fees, data fees, investment research costs, investment interest, margin interest, payment in lieu, stock loan fees, and home office expenses. One note about home office expenses, the IRS has kind of loosened up a bit on that in recent years. Back about 10 years ago, it was a big area of interest that people were abusing it, and now they've loosened up a little bit. They're not scrutinizing it as closely, and they've made a default amount or a allowable amount that's not questioned for a home office expense if you have a business in the home. And that's something to look at if you do choose to go that route. Okay? Let's talk about also, for those of you who are on my year-end tax lecture or webinar, I talked a bit about the new 3.8 net investment income tax, and that is part of the Affordable Health Care Act. It's a tax that goes on net investment income that impacts both investors and traders. Being a trader does not get you out of this, but investment income that you pay the tax on is reduced by allowed expenses. So if you're an investor and those expenses are disallowed as miscellaneous itemized deductions, they're also disallowed for a net investment income tax calculation. And so theoretically, the net investment income tax is allowed, could be less for traders. Now, this is all on a new form. That's form number 8960, the net investment income tax form that gets filed with Form 1040. I'd love to give you more details, but in fact, there's only draft instructions to this form that were released January 7th. So we're all still struggling to get our arms around what exactly the IRS wants to do with this. So it's the first year in 2013 to file this. Let's talk about some of the specific requirements that the IRS requires to be a trader. They have a three-factor thing that they look at. And the first one is a trader must seek to profit daily in the market movements of prices and securities and not from interest, dividends, or capital appreciation. So most of us investors that have stuck away our pennies in our piggy bank, we invest long term, we look to get interest and dividends or capital appreciation over the longer term. A trader seeks to look at the market daily and gain increases not from these payments that are issued, but from the swing in the marketplace. It says right here, a trader seeks to catch marketplace swings and profit from these short-term changes rather than to profit from long-term holdings. So that's the key factor. Let's go to the second one. Trading must be substantial. Now, what is substantial? Substantial is substantial every day, or substantial 3 times a day, or is it 4 times a day, or 5 times a day? There are literally hundreds of tax court cases in this area, and basically the IRS says that 1 trade a day, 2 trades a day probably doesn't make you a trader. There was one gentleman who consistently did 10 trades a day, and the tax court ruled that he did not qualify as a trader. He was an active investor, but not a trader, because he did hold a lot of his securities long term. There were several factors, but they looked first at, was he looking for short-term swings, and was his trading substantial, and 10 wasn't enough. And then the trading activity must be carried on with continuity and regularity. There's another court case where the person treated themselves as a trader, and they did 250 trades in the first 3 months of the year, and then only did about 50 trades in the other 9 months. They treated themselves as a trader based on these 250 trades in the first 3 months of the year. But the IRS said no, they are not a trader, because there was no continuity and regularity to their trading. It was all bunched up in the first half of the year. Okay, so there are other considerations. Holding period, we've talked a little bit about that. The frequency and the dollar amount of the trades. Substantial, that was a word that we talked about back on this other side. Trading must be substantial. So if you're treating yourself as a trader because you're putting $500 in and out of the market 10 times in a day, that probably isn't going to work. They want you to have a good portion at risk. The extent to which trading is pursued. We talked a bit about having another job as a regular job and being a trader. I think it can be done. But I think you have to really show that trading is a substantial portion of your life too. It really needs to be a not a full-time, but a good-sized second business for you. Clearly, that's also supported by the next criteria, the amount of the time devoted to the activity or business. Now, it's been interesting, some of the court cases in this area, because they've even looked to the passive activity rules. And for those of you that have had other investments where you've been passive in, you know that you have to have at least 500 hours devoted to that business in order to be considered active and to deduct any losses. They've actually not applied that 500-hour rule to the trader rules, but they do consider it. So it's something to consider. That basically means, and this is my way of looking at it, that you're devoting at least 10 hours a week, 10 hours a week to trading actively in the market. So that's something to think about. They actually are looking for more than 10 hours a week. So, but I wouldn't be at any less. Okay. And one other thing is that you have separate bank accounts and separate trading accounts for your trading positions as a trader. Offices and personnel obviously are kind of secondary, but the bank accounts or the custody or brokerage accounts are critical. They like your trading vehicles to be separated from your long-term holding vehicles. Now the question has come up in the chat box is, how do you determine short versus long-term? A short holding position is any security that you hold for less than 1 year and 1 day. So obviously a long-term gain or loss or security is one that you hold for 1 year and 1 day. So that's the definition of that, and so that we clear that up. Now, I talked about how there's really a long history of the challenges in the court. And what's interesting about this is that it goes back in the original court case that talks about being a trader and deducting investment expenses is thanks to a nice historical friend, Pierre DuPont. And so one of the founders of DuPont Chemical, one of the heirs to that fortune. And in a 1938 case he brought into the tax court, he wanted to deduct his investment expenses. So when I say there's a long history of the IRS challenging this position in the court, I really mean there's a long history. So that amounts to 76 years of court cases in the courts. So what is the court cases have found? Is there a trend here? And it's back to those three factors that we talked about a little bit earlier. First of all, that trading is substantial. Substantial meaning more than 1 or 2 a day. That you sought to catch the marketplace swings, meaning short-term swings in pricing during the day. And notice that I put short-term in the next bullet point in big, bold letters. Profit is from short-term trades rather than from long-term holding of investments. So again, these are the same three factors that we talked about back at the beginning that the IRS wanted to have. So let's talk about some of the things the courts have looked at more specifically. First of all, I want to mention here that they've been very consistent in their rulings with what the tax code says and the IRS guidance says in this area. And the other thing is it's not just having one of these factors, it's having all three. Everything must be present. It's not an or, trading is substantial, or it's a trading is substantial and. So that's something to be very, very cautious of. One of the things that I wanted to read to you is from a well-cited and followed case in the area and what the Federal Appeals Court said. And I didn't include it in the slide, but it's a nice quote and something I want to read here. It's in order to be the Federal Appeals Court stated, in order to be a taxpayer's activities must be directed to short-term trading, not to the long-term holding of investments. And income must be principally derived from the sale of securities rather than from dividends and interest paid on those securities. In determining whether a taxpayer who manages his own investments is a trader and thus engaged in a trader business, relevant considerations are the taxpayer's investment intent, the nature of income derived from the activity, and the frequency and extent and regularity of the taxpayer's securities transactions. So that's exactly what these things say here. So I want to read that they've been very consistent. So what kind of things do they look at? Total number of trades. The question arose is, are 10 trades a day enough? You obviously should consult with your own personal tax advisor here and their position on this. I will tell you that if I was your tax advisor and I had looked at your return, I doubt that I would tell you that 10 trades a day is enough. This is a very tough standard to meet. It's a high audit probability, And the court cases have been very clear that they are looking to have it be a very regular basis. Earlier I mentioned the guy that had traded that at that level, and he was ruled out as a trader. So I think you really got to look at this as having significant numbers of trades a day. Holding period, I think I can't stress that enough, that the majority of your holding period will be short term. And in fact, in a lot of cases, will be daily. Timing of the trades. In other words, by timing, I talked a bit earlier about the court case where they did 250 trades in 3 months of the year and only 50 in the last 9 months. That didn't count. So in other words, it's got to be consistent across the year. If you did 250 trades in the first quarter, they're looking for you to do 250 in the second quarter, 250 in the third, and 250 in the fourth, or roughly that amount. So let me give you some examples. In one tax court case, 2 taxpayers made 83 purchases and 41 sales in 1 year, and 76 purchases and 30 sales in another. Both had taken the position that they were traders. Both were denied assessed tax, penalties, and interest. So again, secondly, holding period. Let's take another court case. The tax court found that a taxpayer who executed more than 1,200 trades in 1 year and more than 1,100 in the second year, so that's a lot of trades, was not a trader, because a large number of the trades did not sway the court, because most of the profit came from holding the stock long term. There's a couple other things. There's a more recent case where the tax court ruled against the taxpayer because the trading was not deemed to be substantial. The IRS conceded that the taxpayer was trying to catch the daily swings in the marketplace. However, in the 2 years that the taxpayer claimed trader status, he only made 60 trades in 1 year and 212 trades in the second year. And the court found that this was not substantial because there was only twice that he made more than 10 trades in a day. So it kind of shows that you've got to meet both criteria. So again, what's the important takeaways here? That you're in the market daily, that there's numerous transactions, and you seek to profit from short-term swings. Now let me give you a couple more examples, and I'm kind of going through these court cases for a reason, because they really give you a flavor of the kind of things that the IRS is looking at if you take a trader's position. The tax court found that a taxpayer was not eligible to be classified as a trader when the taxpayer made 323 trades during a year. And this is my example that I was giving before. 94% of those 323 were in 3-month period, and none during the 6 months of that year. So instead, the court said that the trading was sufficient during the 3-month period. However, for a quarter of the year was insufficient for trader status. So in other words, you've got to be a trader for the year. So I think this is an important thing. And I want to stop here. Does anybody have any questions on these tax court cases? And I know there's one question out there that I haven't answered, and I'm going to come back to it, so be patient with me. But is there anything in this area that I need to come back to? Okay. Now let me come back to a question that's arisen about these investment expenses, and hopefully I can find the slide. There it is. And I'm going to go back one more. And let's talk about investment. First of all, you have to be itemizing deductions. And then there's 2 limitations. And this is a little bit confusing to explain in words. It's one of those things that it's easier to see when you do it. The first one is that investment expenses are miscellaneous itemized deductions. So once you get to the point you're itemizing, you add up all your miscellaneous itemized deductions. So what are they? Those are your account fees, your safety deposit box fee, your tax preparation fee that you pay to your accountant is a miscellaneous itemized deduction. Any legal fees you might have paid. If you bought uniforms, sometimes those are in that group. So there's a lot of things that come into that group. And then you take 2% of your adjusted gross income, or AGI, and you say that amount is, let's, for argument's sake, 2% of my adjusted gross income is $20,000 if my adjusted gross income is $100,000. And these miscellaneous itemized deductions only total $15,000. You can deduct none of them. If they total $25,000, you could deduct $5,000. Then the P's limitation kicks in. Okay, then you add up all your itemized deductions, any allowable medical expenses, your state and local property taxes, your state tax, your mortgage interest expense, your investment interest expense come to the total. Then you go back to your AGI, and if that's more than $254,200, they start phasing out. That's a second calculation. That's 3% of the amount over the two amounts cited in this slide. And those amounts, by the way, are not the 2013 amounts, they're the 2014 amounts. So just as a word to wise, when you go to prepare your 2013 amounts, you're going to see two amounts lower than this. The 2013 amount is $250 for singles, and I believe it's $300 or for married filing joint off the top of my head. So that's kind of a wrap-up. If you're a trader, you're going to treat this as a business. So on to Schedule C. That's where individual sole proprietorship businesses are reported, and single member LLCs are reported. They're fully deductible on this. Now, couple things that I want to go back to, and it's my next slide, and hopefully, there it is. I can flip right back to it. Let's talk about Schedule C reporting and audit risk from the IRS. The IRS every year names their top 10 areas to audit an individual tax return, and Schedule C is almost always there. And it has been one of the areas, if any of you listen to what the IRS says or reads their blogs or reads their commentary that come out every once in a while like I do, it's one of the ones that they're talking about the most. It is like a Schedule C in and of itself really shouldn't draw an audit, but a Schedule C as a trader is likely to, because the IRS feels this is an area that is not commonly done well or abused. So you need to be prepared to be audited if you take the position as a trader. It's best to plan to be audited. I always tell my clients, I want you to plan to be audited so you have documents, rather than scramble when you're audited to produce documents. It always turns out much better for you if you have contemporaneous documentation. So I just want to give you that clue. I told you, I started out earlier that I wanted to say document. Even if you don't take the position as a trader, document is an excellent way to approach your tax return. Because if there is any audit or anything, it's much better to have it at hand than it is to have to put it together again. All right, so a couple other questions out there, and I want to get to them so that one question arose that they rejected the trader status in that for that one case where the gentleman held it for long-term holdings. By long-term holdings, I mean they held the security over 1 year. However, several months might do it to you too. It's still, if you held, they're really looking for people to be in and out of the market in a very short time frame. Almost daily. They really like that daily swing trader. They don't want somebody to buy something and hold it for 2, 3, 4 months until the market shifts. They're looking for you to really be playing the market on the shorter, tighter swings that occur daily. Someone has asked, how does this relate to the Canadian CRA rules? And truthfully, I'm not a Canadian expert. It's not something I can ask, but I would suggest, I don't even know if their rules are similar, so I think you need to go talk to your person at theirs. And finally, it asks if a trading within an entity like a partnership, LLC, or S Corp helped to strengthen the trader status claim or reduce audit risk. Possibly. It's possible, but especially if it's a single member LLC or a family partnership, or even what I call a spousal LLC, a husband and wife, which can be filed on the Schedule C if you live in a community property state. If you don't, it has to have a separate return. They will look at the substantial number of trades and that you're holding position short term, et cetera, et cetera. The three criteria that we've been talking about throughout this presentation, because they will look through to that activity. So although you can do it that way, and I might suggest that if you are going to take the position as a trader, that you form an LLC to protect your other assets. They will still look through it. S Corps have similar situations as partnerships and LLCs. It's not a form of organization we see as much anymore for new entities, and probably not the best solution. And then the next question is that as long as you don't take the trader write-offs, you're not going to ride you as hard, correct? Well, if you're not taking the trader write-offs, you're an investor, and obviously that's their default position. And yes, they're not going to look as carefully at that, because you're not going to be filing a Schedule C. So I've got one more slide here, and I've got time for a little bit more questions. Never know how this is all going to work. So let's go to the wrap-up. Being a trader can result in significant tax benefits, as we discussed, because you can deduct that. It can reduce both your income tax and the new net investment income tax. But it's an area that requires careful consideration. It's very easy to fail the IRS's tax. And when you fail, you can be assessed additional tax, penalty, and interest. So it's something that you really need to consider carefully with your tax advisor. This is one area where if you're preparing your own taxes, that probably if you're going to do this, it would be wise, even if you didn't have an accountant prepare your taxes, to have a discussion with them about taking this status. I have an analogy that I like to look at this, and it's that of the shark diver. For those of you who are fans of Shark Week, they haven't had for a while, but Shark Week is overdue on one of the cable channels. The IRS and the tax court are the sharks in the water circling the shark cage of the diver or the trader. The diver's the taxpayer, and he's built his cage using his own materials and facts, relying on it to protect him. So, in other words, you build your tax return or your shark cage on your facts and what you know about the tax code and how you match your facts to the tax code, and it's as strong as you can build it. And in this case, the cage is made up of stock transactions, daily, numerous quantities, and profits. So that's what makes up your shark cage to protect you from the IRS and the tax court in this area. It's obvious what my analogy is here. If the cage is strong, it protects the driver. So, and then another question, and I'm going to wrap up with, I think, this one, and it's kind of from a risk perspective, how bad can the additional taxes and penalty be if the status is refuted? Well, first of all, it's the number of years it strikes down. And it also depends on how much the expenses you've deducted. Let's say you've taken advantage of all the expenses that are back here as for traders to deduct, and let me see if I can get those back up here. There we go. And let's say those fees, all in all, account for maybe, I don't know, $25,000 worth of expenses. If they're disallowed and your tax rate is 25%, you owe 25% of that. So 25,000, 25% is roughly $6,250 in tax. You owe penalties on that, and they can assess that in several different ways. And if your $6,250 is more than 10% of your total tax, you instantly have a 10% understatement penalty. And then the penalties can mount from there, plus the interest on both, which right now the interest rate is that the IRS is charging is 3.5%, and that changes quarterly, so that's really something you can't estimate. So it can be substantially. So that's what I would say. So it's something to consider carefully. And so are there any other questions? I've got one that I'm going to address offline, and I want to say a couple of things. One question has arisen that if you start at a later point in the year, say in September, and it meets all the criteria after that, will it qualify as a trader? And I'm going to answer you probably not. If we go back to the case where the gentleman had 314 trades and most of them were in one quarter, but he didn't qualify as a trader as a year, I think that the same would be said in this case. If you start late in the year, it's likely that you do not qualify for the year you start in. So I would think that you have to, but if you started now in January or February, you probably would qualify. So I think you have to think of it that way. Couple of things. I want to ask you all to stay on the line and take this survey because it's very important for us to know what we're doing well and what you like and you don't like. I'd also like to encourage you, if you have any other topics you'd like to have us cover in the tax area, because there's probably lots of other things you'd like us to cover, that you let us know, and so that we can develop webinars for them. And I also want to mention to you that next Wednesday at lunchtime, I'll be doing a webinar on our 1099s that come out soon, February 15th to be specific, and going through some of the things to look for in your 1099s and how to work with them. It's going to be very fast and furious because there's way too much information to cover. So I want to encourage you all to attend that. So can I throw the ball back to you, Cynthia, for the survey?
Well, certainly, Nancy. I've just opened it up on everyone's screen. Now, there's just 3 short questions, and 2 are multiple choice, so we do try and keep it easy. If you would, please make your selections, and then there's a Submit button in the lower right-hand corner of the screen. But I also want to point out question number 2 is not for your questions. If you have questions for Nancy, hold on, and once the survey is finished, we'll get back and answer any remaining questions. But that's a great place for any topics or suggestions for upcoming webinars. I appreciate the input that you have, and the poll is about to end, everyone. So if you would, please go ahead and click that Submit button. I actually review this with management on a weekly basis, so your answers are very helpful. And as Nancy mentioned, we actually have 2 separate webinars coming up on understanding your tax forms, or that 1099 form. As she mentioned, we do have one coming up on the 29th of January, which is next Wednesday, and there is another one scheduled after those 1099s are released in February. Now, if you're interested, please check our website. You can find information and even register for these events. Underneath the education menu, there's a webinar section, and the live webinars will give you access to this to the registration information. By the way, these are located underneath the account section within our education pages. Now, if you're not able to attend live, simply sign up, and you'll also get a direct link to that recorded playback. So I did want you to know that we are very interested and working on some additional items as well. So Now, I do want, since the poll has ended, and thank you everyone, simply close that polling panel with the X that's included on the title bar. And if you do have any additional questions, you can double-click the chat panel title bar and it will expand so that you can view and submit any additional ones. Oh, well, thank you, James. That was a worth waiting for here. And I also want to thank everyone else for your participation. Now, Nancy, have you seen any additional questions that are coming in?
Yes, there's one out there that it's a court case that I didn't cite in my materials here today, but it's one that I read in preparing for this, and I read, probably about 60 of these. And so someone has asked us, going back to the 1 to 2 trade average a day, that's 400 to 500 trades a year, and again, the only job or business, do you think it's not worth trying the trader status? So I'm going to answer this by kind of telling the tax court case here. It was a situation of a retiree, so I don't know if you are a retiree, but that would be someone that might do 1-2 trades a day. And that was their only job, obviously, because they're retired. And so they took the trader status to deduct the thing, and the tax court didn't hold it up, because there were 2 factors that they struck it down on. One is they didn't think that 1 to 2 trades a day was substantial. They actually said in their ruling that they were an active investor, but not a trader. Active investor was the exact term that they used. The second thing was that they looked at the time period. And even though they were making 1 to 2 trades a year, they were holding the majority of their position over a longer term. So they might be trading in or out of 2 or 3 securities daily, but they were holding 10 or 15 long term and not trading those at all. So those were the things that they looked at. So they're really looking to have you trade the whole portfolio daily. Now, I have seen, and I have seen it successfully done, where the trader really bifurcates their portfolio. They create one account that holds their long-term position, or as I prefer to call it, their nest egg position. That's their position that they don't trade very often. They hold for their long-term investments. They hold for their dividends and everything else, and treat all the expenses associated with that account as if they were an investor. And then they have their trading account separate and apart, and this is where, if you remember in one of the slides, and I probably won't be able to find it fast enough, where I talked about separate bank accounts, and I did find it. Lucky me today. That's where I'm talking about creating a separate account for your trading activity. They traded in a totally separate account, same brokerage, but totally separate account, all their trading. And that's where they traded every day. And they took the investment expenses related to that account on their Schedule C. That worked. I did see that happen, and I have done that way. In fact, I've prepared a tax return that way. So I know that it can work, but this person was trading in their trading account approximately 70 trades a day. They didn't hardly ever trade in their long-term account, but they treated it as if they were 2 separate taxpayers almost. So it's something to consider, and something you can structure it that way. Are there any other questions? I think we've covered most of them. I'm going to go back through and see if I've missed anything. There is a question, if you set up a single member LLC for your trading, will the IRS treat you as a trader or an investor? And the answer is you still need to meet these criteria. You need to be trading frequently in the market. You need to be substantially trading a substantial portion of your funds, and it really needs to be a business. So the answer is the single member LLC structure doesn't make you a trader. You still need to meet the other criteria. So if there's no more questions, I encourage you all to join me on Wednesday for the 1099 seminar. I'm hoping it will be helpful in preparing your tax returns, or at least knowing what you need to get together for your tax preparer. so that you can go through that, and we'll talk about that a bit on that day, and hopefully be able to get through all the material I've got put together. I was looking at it earlier today, and I'm going, this is really too long. Somebody has asked since then, I'm not keeping up with these questions here, does the instrument have any bearing on frequency, stocks versus futures, or option traders who are a holding period less than 30 days? The answer is that the type of security has no bearing. But if you're an option trader, they're looking for you to look for short-term swings in the options. They're looking you to be in and out of those puts and calls several times during the day. So the same kind of frequency rules apply. So just buying an option and holding it 30 days till it matures isn't going to make you a trader. So I hope I've answered all your questions, and I encourage you to contribute to throw out ideas that you'd like to have covered to Cynthia, and she'll pass those along to me. And I hope to have you all join me on Wednesday.
Well, Nancy, thank you so much, and especially for sharing your expertise with all of us. It really is very helpful. And as a reminder, Nancy's going to be talking about the 1099 that you'll be receiving later on in February. So if you can join us next week, fantastic. But also, if you're interested in the material, may not be able to join us, remember, you simply need to register, and you will get a direct link to that recorded playback soon after the event ends, like you will later on this afternoon. Also want to remind you that these slides are available and will appear in a separate browser window as you do exit today's session. So once again, great deal of thanks to Nancy Nelson. It's her dedication to this that's really brought you today's webinar. She wants everyone to be able to benefit from the experience here today. So thanks, everyone. We appreciate the time you've spent with us. Have a great afternoon, everyone, and make sure that you do trade smart. By the way, if you do have any suggestions on topics that you weren't able to include in the poll, you can always send them to me at webinars@interactivebrokers.com. I'd be happy to share those with Nancy as well, and perhaps come up with some additional topics to cover on tax information. So thanks to everyone once again. Have a great day all, and remember, trade smart. You can exit using the X in the upper left-hand corner of the screen. Thanks all.